Hey everyone, welcome back to episode number 78 of the Meet Kevin Report. And today we have futures down about one third to about two-thirds of a percent, or two-fourths of a percent actually. If we look at the Nasdaq, S&P down about half a percent, Dow's down about a third just to start the day here. Treasuries sticking around that 3.36 level here. Oil kind of flat. You've even got gold down today, so a little bit of a bearish day to start, at least, possibly because everybody is nervous for CPI on Wednesday, which if you haven't yet watched my Fed Catalyst Watch Before Wednesday video, I encourage you to watch that so you can get caught up with all the expectations this week for earnings and also very important reports. So we'll go through, so you'll be able to go through all of those. Very important. Now, what we're going to start with is we're going to talk about this new EPA rule that's likely to be announced very soon. There's one person here saying no sound, but I think the sound should be fine, so they might be on mute. All right, perfect. So let's jump right into the New York Times piece here on what the Biden administration might be up to, and yeah, I'll take it from there. So thank you so much as always for being here, and let's get started. So, and we will press this button very soon. There we go. Okay, here we go. Well, the Biden administration is now proposing or about to propose some pretty large new electric vehicle rules. Easiest thing to do here is pop on over to the New York Times and see exactly what this sort of pre-leak is regarding electric vehicles. Take a look at just the headline here. EPA set to propose rules meant to drive up electric vehicle sales tenfold in what would be the nation's most ambitious climate regulation. The proposal is designed to ensure that electric cars make up the majority of new auto sales by 2032. Right now, electric vehicle sales are closer to maybe 5-6% of total sales. Now, keep in mind, this is really important to remember, and we'll want to see if this is related to this, but the Inflation Reduction Act gave us somewhere around, let's call it $389 billion for energy-related items. However, Goldman Sachs believes that that number is actually going to be a lot closer to about $1.2 trillion via the Treasury Department simply interpreting rules more loosely in favor of the Democratic agenda. So let's see how much of this New York Times piece relates. Let's see. Biden administration is planning some of the most stringent rules on auto pollution in the world to ensure that all electric cars, note not hybrids here, make up as much as two-thirds of new passenger vehicles sold in 2032. A lot of companies, by the way, talking about banning electric vehicles, banning non-electric vehicles by 2035. California is one of those. New York, I believe, is another. Anyway, that would represent a quantum leap for the United States, where just 5.8% of vehicles sold last year were all electric, and would exceed Biden's earlier ambitions to have all electric cars account for half of those sold in the country by 2032. That's because now he's trying to get up to 67%. So I'm curious to see how they're planning on setting this up. Take a look at this. The administrator of the EPA is expected to announce the proposal limits on tailpipe emissions on Wednesday. So in other words, this would simply be some administrative rule, not a rule that is passed by Congress, but rather some form of administrative rule on emissions and how green vehicles need to be, which essentially would drive people solely into electric vehicles in order to make them compliant. It was originally set for Detroit, this meeting on Wednesday. The requirements would ensure that electric vehicles represent between 54 and 60% of all new cars sold by 2030, rising to 64 to 67% by 32, said people familiar with the matter. Rapidly speeding up the adoption of electric vehicles would require other significant changes, including millions of new electric vehicle charging stations, an overhaul of electric grids, and the minerals and supplies for batteries. Now, the neat thing is the Inflation Reduction Act does exactly this. These items that are listed here are essentially enabled by the Inflation Reduction Act. And so, to some degree, you have the political game that's being set up. I mean, think about the political game. The political game is simple: convince a bipartisan measure to pass on green energy. That's sort of step one. We got that, right? That's the Inflation Reduction Act. Then, well, I should say, ensure that act includes leeway for the current administration, which in this case, obviously, is the Biden administration and Biden's EPA, and then allow that leeway to stretch the existing budget via the IRA, which is what Goldman says, which Goldman predicts will be a 3x. And so, in my opinion, what's fascinating about these rules is what you really have is you have a game of almost what looks like 4D chess in preview, but in hindsight, totally makes sense. So then, step four, have your democratically controlled, or I should say, Democrat controlled departments uh, create strict rule sets that require more Reduction Act leeway, right? Because basically, if the EPA comes out and says, "Hey, we need to get to 67% by 2032," you know what that means. So the example, right? Pass a small bill with leeway, then implement strict rules. Now, Treasury has to go super strong on leeway side to enable those strict rules. So, in other words, the money's already there. You don't even have to go to Congress to create more money for what they need here, which are, again, significant changes to millions of new electric vehicle charging stations. Think about what the Biden administration has already done. Hey, Elon Musk, can we partner with you? And can you build us thousands of more electric vehicle charging stations, and we'll pay you billions of dollars to do that? Of course, the answer is going to be yes. An overhaul of electric grids, and that's fantastic potentially for megapacks as well for Tesla, right? Which we just heard about that new Shanghai expansion for megapacks that could create as many as 10,000 megapacks. And then, of course, helping with battery materials. The proposed regulation would go through public comment and could be altered by the government before becoming final to make sure it meets legal challenges. It could become an issue in the 2024 campaign as a future administration could undo or weaken it. Notice here, they don't talk about Congress because Congress has already been authorized, or the purse strings have already been authorized via right here. The new regulations come on the heels of the 2022 Inflation Reduction Act, which has helped stoke demand for electric vehicles by providing the tax incentives we've seen, as well as incentives for battery manufacturing and critical processing and mining. And there's been nothing that's been made more of in America right now than factories in 2022. That's something that's pretty incredible to think about. We was reading a report on this yesterday, and it's a worthwhile point to mention that in 2022 we saw about 120 billion dollars. Well, actually, it was closer to 80, 108. It was 108. Let me see if I can pull up my note. 108 million, or golly, Kevin, $108 billion. Oh, I got it here. $108 billion of construction related spending in manufacturing. Uh, that contrasts to the next highest level, or compares to the next highest level in 2015, where we spent about $83 billion, which means we spent somewhere around $25 billion more on manufacturing. This was according to the Wall Street Journal. We spent more money on manufacturing than we did on building schools, healthcare centers, and office buildings. Much of that growth was focused on EV, tech, batteries, semiconductors. That's because that's where the stimulus checks are going. Only 10% of the private workforce right now is actually in manufacturing. However, the sector still is behind on a level of employment by about 800,000 jobs. So if you're looking for more growth, the growth is likely to be manufacturing. Look particularly here at this chart on screen now. Construction spending related to manufacturing. I mean, we've blown out of the water the previous sectors here. Now, what's also pretty incredible though is how much these factories are automating, these new modern factories. Stanley Black and Decker gave us an example, and they said that their automated lines used to have between 50 to 75 people per line to make power tools. Today, those factories only require about 10 to 12 people. And in the future, Stanley Black and Decker expects that only 2 to 3 people will be required per line on their manufacturing plant. I mean, that's a decline of 95% of the amount of labor that's required in manufacturing, which is pretty remarkable to think about. But what it really suggests is that you probably don't want to be investing in labor, not that you directly would invest in labor anyway, but what you probably want to do with this expansion of factories, oops, is do whatever you can to find out how can we make sure that you are exposed to companies that are building these manufacturing plants and are getting these massive stimulus checks. And let's see, we talked about this. Let's look at the rest of the article here from the New York Times. Transportation is the largest source of greenhouse gases. Okay, why are we having some HDMI problems again here? Anyway, the proposed auto emissions rule is even more demanding than the target laid out by Mr. Biden in 2021. Speaking on the South Lawn, that was back when he was talking up the Ford F-150, fine, whatever. Climate change experts say that the transition to zero emission vehicles must move faster to avoid a planetary disaster. So they could just go into why, basically. Proposed rule would not mandate electric vehicles make up a certain percentage of sales. Instead, it would require automakers to make sure that a total number of vehicles that they sell each year did not exceed a certain total emission vehicle limit. Oh, that's interesting. It's one way to do it. Basically, it puts the onus on the companies, not on the consumer. So it makes it a little easier for consumers. So in other words, consumers could still buy an ICE car, but there will start being some restrictions on. I would imagine a way a manufacturer could do that is they could just raise prices on the ICE cars to limit some of the number of sales there while maximizing their profit, and then lowering the costs on electric vehicles, which that's basically what this bill does is it drives up the cost of ICE vehicles and down the cost of electric vehicles. Even manufacturers that chafe against the regulations would prefer to deal with one set of rules rather than meet specific rules from a bunch of different states. Like here's that California line about banning by 2035. One of the biggest items needed for electric vehicles is charging stations. 2021 infrastructure law provided $7.5 billion to build a new network of about 500,000 charging stations. Yeah. So pretty incredible that basically these massive stimulus checks are coming to the electric vehicle world. Obviously, I think that's a boon to a company like Tesla, but it'll also be a boon to companies like GM. GM has a fantastic Ultium partnership with LG to make batteries. They're building a pretty large plants, actually multiple sister plants in Ohio and Tennessee. What's crazy is how much money, just to give you an example of how much money is going into some of these plants. Uh, if we just Google, just for giggles, the cost to build a factory, usually you look at a cost to build a factory of anywhere between $5 to $15 billion. Let's just say for giggles, we'll take the average. We'll take the number of about $10 billion. Well, GM and the LG partnership just got a federal loan, which is super sweetheart deal of $2.5 billion, so about 25% of it. The rest they can get commercially. And then they're getting about $666 million in state grants and bargain electricity rates to actually operate those plants. And so what's remarkable is you're seeing governments at every level and the monopolies at every level, whether it's the electrical departments, the cities, the counties, the states, the federal government, everybody's throwing money at these factories. And it's not just going to be a company like Tesla that succeeds. It's probably going to be the chips manufacturers. It's probably going to be your chip related companies like the chip equipment manufacturers, the companies that actually take in those chips and use them, like Apple, for example, by taking the chips and turning them into a consumer product. But it shows you how much money is just flowing in. It is quite remarkable, and how they're pulling it off. Now, there has been some chips weakness over the last couple weeks in terms of a trade that's worth paying attention to. For example, if we look at Goldman Sachs on chips, this is a piece from Goldman Sachs on chips. Let's make sure we go ahead and have this screen up here that reminds you about the expiring coupon code in 2 days on CPI Day. Prices will be going up for those programs on Building Your Wealth. Link down below. You get lifetime access, and you can now buy, now pay later to get access to them, lifetime access to them. You pay as little as $30 a month, which is pretty cool. You instantly get access to those course member live streams. So take a look at this. Hedge funds net sold tech stocks for the third consecutive week. And if you look at just semis specifically, this is a long, they call it an LS chart, long short ratio chart. And basically, the higher the level, the more short, or sorry, rather, the more long in this example, the more long hedge funds are. And the lower the level, the more short they are. And what you can see is hedge funds went into 2023 extremely bearish. And they came out a little bullish there around February, but have already started selling off again. However, look at how uncrowded the semiconductor space is right now, which happens to be where the majority of the stimulus checks are rolling. And look how uncrowded it is. The long short ratio is basically even. We're basically at a 1-to-1 ratio here. In other words, for every dollar that somebody is long right now, somebody's short on semiconductors. Now, look, I understand there's been some news that hasn't been the greatest regarding semiconductors and PC shipments and what's going on with Apple. For example, Apple personal computer shipments declined by 40.5% in the first quarter. This is per Bloomberg, quote, marking a tough start to the year for PC makers, still grappling with a glut of unsold inventory. That compares to Dell, which looks like it's down about 30%, HP down about 28%, overall market down about 30%, Asus down about 33, Lenovo down about 33 as well. You've got, let's see here, Apple shares down about 0.8% in pre-market when this article was written. Even with heavy discounting, channels and PC makers can expect elevated inventory to persist into the middle of the year and potentially into the third quarter. The silver lining is that cooling demand is giving manufacturers time to make changes as factories begin to explore production options outside of China. That is true. You are starting to get sort of this what I call re-globalization. A lot of people during the post COVID era were saying, "Oh, here we go. We're going to get deglobalization. And we're going to get massive inflation because of that." I don't think so. I think we get re-globalization. We actually get even more efficient supply chains than we've ever had before. TSMC also this morning announced that they missed sales estimates for the second consecutive quarter in a sign of continued weakness in global electronics demand. First quarter revenue for the world's biggest contract manufacturer of chips was 16.7 billion. That's a sharp slowdown in March. Sales were down 15% last month relative to the prior year. Companies listed shares down about 1.1% in pre-market. Global PC shipments crashed 29% in the first quarter, led by Apple's Mac lineup. Apple's Mac lineup, the one that is actually leading the decline. Now, Apple's iPhone, iPad, and wearable segments have been doing better than the Mac line, but something to pay attention to, especially if you're an Apple investor. Now, what I think about this, and we could just sort of just quickly look at the market too. Let's see how they've moved. TSMC pre-market right now down about 1.54. AAPL pre-market right now down about 1.3. So what I would do is I would pay attention to see how these stocks move today on these basically pre-announced sales weaknesses, because I think what these companies are doing is they're providing you the bad news now, and then that way when earnings come around, the expectation is already set, and it's actually a lot easier to beat on your earnings report by pre-releasing the bad news. And the pre-release bad news is only moving these stocks about 1 to 1.5%. It's probably because so many people are already short these chip and tech companies. And so I actually find that a big element of I see a lot of optimism in that. I love that. There's so much of a short play in the chip sector right now, because when we combine that with what we're expecting to see with electric vehicles, which require a lot of chips, superchargers, chips. Pretty much anything tech related, chips, and this is where the stimulus money is going, not only via directly this CHIPS Act, but also the Inflation Reduction Act, and the manufacturing economies of scale that we're expecting to see here in America. Yeah, I think in 10 years from now, we'll look back and go, how could we have not bought chips and electric vehicle stocks? It's going to be remarkable. So that's my take. If you want more of my take, make sure you join those courses on building your wealth, linked down below. All right, next topic. Oh, yes, this is a good one. So the next thing that we are going to talk about is we're going to talk about the debt ceiling. Yes. All right, I should have debt ceiling. All right. Max says Biden's running for president again in 2024. He is. All right. So, all right, here we go. This is fascinating. Now we've got to talk about the debt ceiling. And boy, there is a lot of fear that the United States is going to default on its obligations, specifically treasuries. The way that works is when we stop paying our bills and we start defaulting on the debts that we owe because our debt ceiling has been broached and we can no longer play accounting tricks to extend how long we have until that debt ceiling expires. And then we start calling up people with treasury bonds and say, hey, sorry, we can't pay you, even though that's not directly how treasury bonds work. Mostly because they're paid you receive them at a discounted valuation is the way treasuries work. Just to make a simple example, though, the argument is when the United States starts defaulting on its debt, the stock market could crash over 40% by some estimates, and the bond market could see a massive sell off with a massive increase in interest rates. Massive increase in interest rates could drive our economy into a substantially deeper recession, if not even depression, because we could end up being in a situation where, hey, by July or September, somewhere in that range, when we hit the debt ceiling, maybe inflation will be conquered. But if we then refuse to pass the debt ceiling increase and negotiate some kind of debt ceiling limit increase, then all of a sudden we default on our obligations and we have the worst financial crisis that we've ever experienced in the history of America. That is what some economists are calling for. Now, if we look at what the Federal Reserve tells us about the history of the debt ceiling, we can get a little bit more insight. And of course, we're going to throw up that banner again to remind you that we're just 2 days away from the price going up for those programs on building your wealth, whether it's stocks and psychology of money, zero to millionaire real estate investing, do it yourself property management and rental renovations, becoming a real estate agent, building your wealth with real estate, selling real estate, making YouTube videos and YouTube content the way I do. You can learn all about that via the links down below for those programs on building your wealth, coupon expiring in 2 days. And price is guaranteed to go up. So, the United States has once again reached its debt ceiling in the first month of 2023, a limit that Congress set at 31.4 trillion in 2021. If no action is taken, estimates are that the United States could face another debt ceiling crisis between the X date, which is expected to be somewhere between July 1st and September 30th. Now, since 1960, so think about that. That is 73 years ago. Congress has acted 78 times to deal with the debt ceiling. Not once has America defaulted at all. Not once. However, people say this time is different. And now, with Kevin McCarthy in control of the Republican led House, we could actually end up defaulting on our obligations. Measuring the debt burden. Arguably, okay, now this is where we get interesting about debt. This is where we start talking a little bit more granularly about debt, and then we'll talk about what we think is likely to happen. So, first, a lot of people will make what I think is the very simplistic argument of simply saying, "Oh my gosh, we have $31 trillion of debt. This is ridiculous." And don't get me wrong, the fiscal path that we're on right now is unsustainable. We need to fix the path that we're on. We're spending too much money for how relatively inefficient we are compared to how much money we're spending. So I want to be clear. We have to either become a lot more productive or we have to spend less money. It's very simple. But what I do think is very important is that when we talk about the national debt, that we talk about the national debt relative to how much our economy is growing. And that's actually what the St. Louis Fed says here. That, look, the national debt, the best way to measure it in their mind is to measure it in the national debt as a percentage of GDP. Something that you can do is you can also measure the national debt as a percentage of the interest payments on the national debt. And the reason you might want to do that is because it could give you a little bit of look into even more recent history to show, okay, hey, as a percentage of GDP, maybe we're not actually spending that much money, even as our debt is going up. So if you look at the St. Louis Federal Reserve and you look at the federal outlays chart of interest as a percentage of gross domestic product, what you're going to find is this screen that we're going to pull up here. Let's go grab this window, St. Louis Fed. There we go. Take a look at this particular chart here. This chart will show you that back in the 90s, we were spending somewhere between 2 to 3.1, 2.8 to 3.1% of our GDP on the national debt. Right now, that number is going up, but we're spending around 1.86%. So we could still roughly double and be roughly at where we were at spending levels in about 1991. Now, that's remarkable because it somewhat removes some of that pain that people have when it comes to looking at that nominal debt number. But there are other ways to look at the debt as well. So, what I like to do is I wrote some notes here. I go and I say that purely nominal figures don't actually mean anything. And debt to GDP helps. But what I like is the interest payments as a percentage of GDP. I call that our burden. I wrote this down, right? And that's what I just showed us. Now, as our GDP grows, maybe through an AI boom, an artificial intelligence boom, I write that that is optimistic. Today's debt could actually become irrelevant. And so I make an example here. Imagine this. Imagine that our debt today is $31 trillion dollars and our economy is $23 trillion dollars in size. In other words, it takes us about 1.48 years of productivity to pay off our debt if we were to throw everything at paying off our debt, right? So think about that very simply for a moment. Let's say you owe $31,000 and you make $24,000. Let's assume you have no expenses and you just throw everything at paying off your debt, including no taxes. It would take you about 1.48 years to pay that off, right? Now, what would happen if, for example, these levels tripled? Or one of the levels tripled and the other one doubled. So, for example, let's say your productivity tripled, and now all of a sudden you had income of, instead of $23,000, you had income of $69,000, and your debt doubled. Well, now all of a sudden you have reduced your debt to GDP by about 36.5% because you actually owe less than you're creating in that year. So there is a way of escaping the debt that we have today by becoming substantially more productive. Let's say over the next 10 years, just to be extreme, we're able to 10x our economy, and our economy goes from about $23 trillion dollars to $230 trillion dollars. And our debt 4x's from 31 to 124. Well, all of a sudden we'd look and we go, man, our debt is less than half our GDP. We're killing it. Even though the debt 4x'd, it becomes substantially less relevant over time. So, really, what you have to bet on to not be worried about the debt is, in my opinion, substantial growth in the economy. Now, for the math whizzes who like math, I wrote a little chart over here to make that a little simple and break that down just so you could see how that might work. If your debt on a percentage basis grows by 5%, but your economy, or rather, yeah, your debt grows at 5%, which is kind of almost like what's happening now. Your debt grows at 5%, but your economy is growing at 2.5%. You're growing your debt twice the speed of GDP. That's really bad, right? You don't want that. You want to be in a situation like this, where your debt is growing at, let's say, 2.5%. So it's still growing. The number is still big. But, oopsies, your GDP is growing maybe 10%. In this case, your debt is growing at 1/4 the speed of GDP. This is what you want. So I wrote this note here. When people say, oh my God, the debt is so high, it's really a bad and unintellectual argument. What we really have to do is say, how is our debt relative to the interest payments we're making? How is our debt relative to GDP? And how is our debt growth relative to our economic growth? I think it's our schools that have failed to teach that. Obviously, I mean, I ran for governor on the idea of suggesting we needed financial education in schools. It seems like it'd be very simple to do, but nobody wants to do it. But anyway, anyone mentioning trillions of debt, right? You hear this all the time. You see this on Twitter all the time, headlines. See, I actually wrote, I deleted Twitter and TikTok off most of my devices because I found that 99% of the algorithm is emotion based. And you kind of get that on like YouTube titles as well. But I think logic is within the actual videos. Hopefully, the ones that you're watching have logic within. So I make this argument that, and we're going to go back to what the St. Louis Fred says over here. I make this argument that really, when people argue, oh my gosh, the debt is so high, we have 31 trillion in debt, our country is going to collapse. It's a ridiculous argument because as long as our economy keeps growing, we'll be totally fine, especially if we can grow at a faster rate than we're growing our debt. I mean, think about that for a moment. What I'm really saying is, if America stops innovating, America dies. I don't believe that America was going to stop innovating. I think America is the one place in the world that will continue to be the greatest innovator in the world. I think it's more likely that China turns into a Japan than the United States turns into a Japan. I mean, there are plenty of reports out now showing that Chinese women are less interested in having children After the one-child policy was removed, China's population is shrinking, it's declining, their growth is faltering. China might not be in the same boat where people hope that they will be in the future. And I think that's why China is now freaking out about, uh-oh, we need to be a little bit more friendly to the capitalists because they realize if they don't innovate, they're going to die. And I believe that's true of America as well. Except for America's purposes, I have a lot of enthusiasm for what artificial intelligence and productivity increases in manufacturing are going to do. Remember the Wall Street Journal article we've talked about previously, where the Wall Street Journal tells us that Stanley Black& Decker went from having 50 to 75 people on a manufacturing line in China to in a new modern facility, 10 to 12 people, which is somewhere around 1/5 to even less of the amount of people on the factory line. And now you're looking at potentially the next phase of factories having only 2 to 3 people per line. Those people are then freed up to go make money somewhere else. So think about it. That actually doesn't hurt GDP because you're still producing the same amount of power tools, except you've now freed up 70 people to go do other jobs. And now you've actually doubled your potential output. So GDP growth is a phenomenal way of minimizing the burdens of our debt. We just have to make sure we continue to invest in growing this economy rather than shrinking it. So that's very, very important. So let's keep going with this Fed piece here, and we'll keep that banner up on the course member coupon code. All right, right before the Great Recession, U.S. debt to GDP was hovering around 60%. Following the recession, that ratio rose to around 100%. Then, in response to the COVID-19 pandemic, that debt to GDP ratio rose to 120%. And the St. Louis Fed talks about a few ways we can reduce that. But first, what I want to talk about is at the bottom here. The U.S. has experienced this before. In fact, we hit 100% debt to GDP after World War II. This means our debt was basically the same size as the amount, or as the size of our economy. Following World War II, the ratio reached 97.2% in 1945 as a result of war financing. Moreover, in the 3 decades that followed, U.S. debt to GDP ratio fell significantly. And by 1974, it went from 97.2% to 16.9%. Now, they break down why that occurred, and I translated it over here to save you the time. The drop from nearly 100% GDP to 16% GDP was fueled by a good budget that is actually having a competent government that spent less than it made. 34.7% of that of that decline was because of our budget surplus. I do not see that happening. I just don't see us going into a budget surplus, but it could happen, and I'll show you how it could happen. GDP growth represented about 31.8%, which that's great. And then, of course, you can inflate away debt as well by making it less valuable because as inflation happens, your debt becomes less meaningful over time. To make that very simple, I want you to think about this. If you have a home loan for $100,000 on a home, and in 30 years, and today you're making, let's say, $50,000 a year. So you're making $50,000 a year and you have a home loan of $100,000. It would take you about 2 years of income, assuming you had no expenses to pay that home loan off, right? Well, let's say now in 20 years, you haven't paid a dime off on that $100,000 home loan because maybe you did an interest-only home loan. But instead of making $50,000, you're making $500,000. Well, now with just 1/5 of your annual income, you could pay that debt away. That would be an example of inflating away your debt, assuming that inflation led to those wage increases. Of course, you could also increase your wages by being more of a productive member of society and providing more value, which you could have. You can also have both, and that's exactly what decreased our relative debt from the post-war era to the 70s. So again, 34% surplus, 31.8% GDP growth, and then 15.8% inflation. Now, I wrote that I really think we're going to have a GDP boom once we get through this recessionary environment, specifically driven by advances in manufacturing, chips, electric vehicles. I sound like a broken record by saying that, but basically my pricing power stocks. If you want to know what those stocks are that I really like, just go to meetkevin.com. You'll see my courses, my affiliate links, and you'll also see my ETF. I am a financial advisor. This video isn't personalized financial advice, but check that all out at meetkevin.com. But anyway, I think it's entirely possible, and I do want to talk about this a little bit as well over here, reducing the debt. I think it's entirely possible that we could have a massive increase in GDP. And a massive increase in GDP will also massively increase revenues for the government. And so there is this possibility that you could go back to a surplus. Now, I think our government will end up just spending that money via stimulus checks for businesses that they're trying to prop up, like the energy space. But I do think that explosive GDP growth could be ahead once we get through this recession. So I'm really not personally terribly worried about the level of our debt. And I'll give you what I think is going to happen with this debt ceiling crisis in a moment. But the St. Louis Fed makes it very clear here in terms of three things that could actually help us essentially eliminate the debt. One is fiscal austerity. This is very unpopular. Think about like the lack of trash collection in Greece during the 2010s euro crisis. So fiscal austerity, cutting on spending, schools, whatever, terrible. People hate that. People get voted out of office for cutting spending. Then you have inflation. And then, of course, you have economic growth, which hopefully via the AI revolution and this tech revolution we're going through, that I think we're going to see substantially compound over the next 10 years, we're going to see GDP growth just absolutely explode. And our debt today will be relatively irrelevant in the future. So where does this leave us for the debt ceiling crisis this year? Well, obviously, if we defaulted on our debt, it would be devastating. I personally believe that it's 99% likely, and I could be very wrong about it, but I think it's nearly certain Congress will pass a debt ceiling limit increase. Even after they do, there are going to be people pounding the fist, punching the air, and writing angry tweets about how much debt America has. But anybody who's making the argument that America has too much debt and therefore it's some massive problem is really arguing that America will not innovate anymore in the future. That is the argument. Now, it's very important to also consider that America is very different from a direct household. For example, somebody here is making a reference, Jim here is making a reference to a margin loan. This is not a margin loan. This is fixed debt. It's not like somebody calls up America and says, all of your debt is due immediately. That's not how it works. The debt America holds is a massive collection of 3 month, 6 month, 1 year, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year, and more different various forms of treasury bonds and different forms of other debts and obligations, the social security debts or otherwise. All of these debts aren't coming due at any point. There is no margin call. There's no movement in the marketplace that all of a sudden makes all of this debt come due. It doesn't matter. What matters is, can we afford the interest rate payment? And in the 90s, we afforded twice the interest rate payment. We could afford even more than that. Now, again, I'm not saying that's going to be good for the US dollar. I think in time, as we continue to inflate away our currency, which we will do, remember, every currency that has ever existed has disappeared. Every currency has failed, and the likelihood is that every currency will fail in the future. But personally, the victim of our currency failing is the US dollar, not our assets, our stocks. And dollar, or our stocks and real estate are insulated from that. Instead, it's anything where you're holding actual dollars that is potentially at risk. So I'm not that big of a bear when it comes to simply looking at the debt we have, because I think, again, the United States has plenty of capacity to make its debt payments, even if we needed to turn the money printer on, which we likely will. And even if we do turn the money printer on again, and people argue, well, this can't last forever. I agree with them. I don't think it can last forever, and it won't last forever. But I don't think this is a problem in this cycle. It probably won't be a cycle in 20 years, or it probably won't be a problem in 20 years. It'll probably be more of a problem in 50 to 100 or 200 years. We don't know when. Maybe we never have to worry about it. That's not saying we shouldn't worry about it, but I think what we should focus on now is being as productive as possible, not only as a country, but also as individuals. And that's why I have all those beautiful programs on building your wealth and being the most productive member of society you can, link down below. Whether it's that Zero to Millionaire real estate group, the Stocks and Psych group, or the Elite Hustlers group, really popular right now. A lot of people are bundling those three together. They learn all my perspectives on insurance, liability, LLCs, building a business, gaining income, building your wealth, high margin businesses, low margin businesses, where to invest your time and your money, where to build your wealth. So take a look at all of those linked down below. Okay, so that is my brief on the debt ceiling. Now we must talk about, what else must we talk about? Let's see here. Oh, yes. Oh, the M2 piece would be really interesting. We can talk about that. We talked chips. Let's take a very quick look at the futures market. Still pretty red. Bonds pretty flat. Oil down 1% now. Natural gas has been so volatile. Okay, next up, let's take a look at the M2 money supply. All right, stand by for this really incredible chart. Okay. There's a thesis by the Austrian School of Economists that suggests inflation is directly related to the money supply. That is, how much is the money supply going up or down? And that will be your best predictor for determining how much inflation we'll be facing. Now, what I think is remarkable about that is so far, they've probably been right. In fact, well, it's worth also mentioning the Federal Reserve seems to have been relatively blind to this, which is remarkable. But the Federal Reserve follows more of a Keynesian school of economics, which suggests that, hey, in bad times, we should generally stimulate, and in good times, we should generally implement some more cost cutting, right? But also, the Keynesian theory is that formulas regarding inflation are more focused on actual data we receive rather than on solely the money supply. And this is why some folks say the Federal Reserve was caught flat footed when they were still printing money in March of 2022 when we had 6% inflation, which led to the rapid inflation we saw for the rest of the year. But take a look at this particular chart on screen now, right next to that coupon code expiring in 2 days, and then prices going up for those programs on Building Your Wealth where you get that lifetime price guarantee. So take a look at those linked down below. But what do we have over here? Look at this as the Academy Securities says is an almost embarrassing chart. Embarrassingly bad chart, they actually say. So this chart shows you Bitcoin in black. It shows you the tech index, the NASDAQ 100, QQQM ticker symbol, and it shows you the Federal Reserve's balance sheet. And what it beautifully shows you here is in times of the expanding Federal Reserve balance sheet, you tend to see, ignore Bitcoin's volatility over here, all this black, you tend to see what? Well, the NASDAQ goes straight up with the expanding balance sheet. As soon as we hit an inflection point in the Federal Reserve's balance sheet, what happens to now Bitcoin, a little bit more correlated to the NASDAQ? And the NASDAQ, oh, look, it goes down. And oh, look, the Federal Reserve's balance sheet picked up a little bit over here at the beginning of the year. Oh, look, what happened over here to stocks and Bitcoin at the beginning of the year? Oh, look, they picked up a little bit. So the money supply could be a very, very good tell for what's to happen with assets, what's to happen with inflation. And a lot of folks say that as the Federal Reserve continues to push us into a quantitative tightening cycle, they will actually end up breaking the economy, leading to an earnings recession, forcing them to essentially cut rates to the tune of about 5%. The bond market is pricing in about a 5% rate cut right now. In fact, there's a piece here by Morgan Stanley talking about the bond market specifically. And they actually show us here the prior recessions. Look at that, 90 to 91. 2001 and 2007 to 2009, what did we get? Cumulative easing during the prior three recessions. Oh, look at that. 5%, 5.25%, and 5.5%, which is basically the same thing that you're seeing being priced in today. The yield curve is so inverted today that the yield curve is predicting we are expecting 500 basis points of cuts from the Federal Reserve soon. And probably turn the money printer on again, which would be fantastic for risk assets like the tech indices and Bitcoin. But what's interesting here from academies is they say the following. I'm not sure if we're witnessing a Pavlovian response here, basically algorithms responding to a trend, or the policy that is in place is helping risky assets. Like, is there a correlation here or not? And the chart certainly suggests there is. And in their piece, they go on to talk about the banking crisis, and they talk a little bit about oil, economic data, and the recession. Well, I don't so specifically want to go deep into that because it's not so terribly detailed. But instead, I'd like to talk about this just from the perspective of us as individual investors. What does this mean for us? Well, what this means is if the bond market is starting to project substantial rate cuts, is it possible that the Federal Reserve will turn the money printer on again and stocks and Bitcoin will potentially start predicting the Federal Reserve's U turn and therefore start pricing it in? Some folks think that's exactly what's happening. For example, Bloomberg ran a piece on the front page yesterday that talked about the bond market overplaying the severity of the recession. They suggest that really credit, which is a measure of blue chip spreads and high yields in English, if you can get 4.5% on an Apple bond and 4% on a Treasury bond, that spread is 50 basis points. In a risky environment, you might see that yield for a Apple bond go to 5% and the Treasury stay at 4%. Now the spread has gone up to 1%. That's a sign of risk and of concern. But you haven't seen spreads move much at all. You haven't seen the stock market show much signs of concern. Maybe the banking crisis is overplayed. Maybe the recession that's supposed to be coming isn't actually that terrible. And once the Fed realizes it's conquered inflation, the Fed starts cutting. That's the thesis right now that people are arguing on one side. That's the bullish side. The bearish side is saying the Fed doesn't even realize how much they've already over tightened and how much damage they're causing. And when they continue on this path of quantitative tightening, you're going to be in a world of hurt. And this I actually agree with to some extent. This idea that if we continue this quantitative tightening path up here, we continue, and let's draw a little larger. There we go. If we continue where that orange line is, and we continue this Fed balance sheet runoff, well, the chart would suggest that the NASDAQ and Bitcoin should continue down. But given that our total debt, as we've talked about on the channel, is a fraction of what it was in terms of interest payments compared to the 90s, it makes sense that we could actually potentially stand to continue paying the debt that we have. And really, if we could just grow our economy, maybe this debt isn't necessarily a terrible thing. Maybe the Federal Reserve doesn't need to run off its balance sheet. Maybe it could stay elevated. That's an argument that some of the bulls are making. The bears say, hell no, we've got to get back to where we were before the pandemic. But before the pandemic would be a little bit of a tough pill to swallow. We were sitting around the time of the pandemic at a Fed balance sheet just above $4 trillion, that lower green line. And that $4 trillion has now turned into $8.632 trillion dollars. So you can see this massive increase here from the green line to the red line. That is your expansion of the Federal Reserve's balance sheet, and similarly the United States total debt. So if you are a bull, let's try to simplify this. If you are a bull, you are making the argument that the Federal Reserve does not need to lower their balance sheet, and that what the stock and crypto markets are pricing in right now is the response to basically a pause in tightening. And the Fed is likely to cut rates and pause their tightening, leading to rallies in risk assets as the Fed tries to prevent a recession or limit the blow of a recession and inflation is conquered. If you're a bear, you look at this and say, inflation's not conquered. The only way inflation goes down is if we continue to contract the money supply. That's, again, the Austrian thesis. We continue to restrict or contract the size of the money supply. That continues to crimp the economy as we vacuum money out of the economy. People spend less money. The earnings recession is worse than expected, and you end up in a pretty dark recession until the Fed decides to U-turn. Of course, then you have people like Peter Schiff who say the Fed shouldn't U-turn. The Fed should let the bankruptcies occur, let the failures occur, and let the cards fall where they may. Let that great reset, so to speak, occur, and let's get through the pain we need to get through and start over. That's his thesis, to get back to sort of sound currency. The odds of that happening, I think, are relatively low. I think we're going to keep playing the funny money game for quite a while longer. So we'll see. All right. So that's that. Let's see here what else we have. I think that about covers what we've got today. Let's take a quick listen in over on CNBC and just see if they have anything fun. Hold on a sec. We'll listen together here for a few minutes and see what we got. Mhm. Oh, look what they're talking about. This is what we already talked about. How interesting. Okay, let's see here. Share.
These are union jobs, and it's very hard to switch. It's very easy to make. There are very few parts in an EV versus the ICE. I This was very bad for Ford, and I like Ford very much. Big just for my child trust, but you don't want Ford squeezed on both. Squeezed on ICE and squeezed on EVs.
This is the whole Jonas playbook right here. The pain involved in navigating away from that business.
Candidly, at times I've made a little sport of Jonas, but he's the one who's most right. I think he's the one most right. And it's worrisome because I want Ford to succeed. But you've got this, they'll have to cut for Mach-E. Unless they say, listen, our demand is extraordinary. But wow, I mean, they need prices higher in order to make the transition. And they're not lower. Now, last time, by the way, Tesla lowered, and then the buyers came back,
yes,
and then they raised them again.
That's
so
exactly
it's
right.
certainly not. I mean, he's got the ability because of his unique system. He can rise. It's very hard for Ford dealership network to do it. He's a very smart guy, and he may just be saying, "I don't like the drumbeat of 600,000 Ford cars going out at the end. That I don't like that progression." And that's smart. He's not going to admit it. He won't even acknowledge that Ford has a car.
That's right. He's busy with the Twitter headquarters sign.
Yeah, he's got a lot on his plate. Twitter's going to be immensely profitable. I mean, when it's a private company.
Yes. When we come back.
Wow. Yeah, sure.
We'll get Kramer's Mad Dash countdown to the opening bell. A lot to get to still this morning as a busy week is on tap. Don't go anywhere.
92% of households that kick.
You know what's interesting is I just pulled up the trends for Tesla, and I want you to see the trends for Tesla. So let me share the screen here. Keep in mind, I do this live stream with all these banners and everything that I could throw up using StreamYard. So that's paid promo. But if you wanted to learn more about StreamYard, you can go to metkevin.com/StreamYard or jump on over to StreamYard through my website at meetkevin.com. Supports the channel. All right, take a look at this. If I present this particular screen here, let's do. These are search trends for the Model 3 over the last 5 years. And what's remarkable about this is you actually see an increase, a substantial increase in Model 3 search trends relative to the end of last year. It seems like in the 6 months, the second half of 2022, there's a lot of pain for Model 3s here. Let's try comparing that Model Y search trends. Let's actually just remove Model 3. Okay, here's Model Y. You had a big surge there in January on the Model Y. You have a relative strength of about 25 today. But look at that. In that second half of 2022, your search trends were actually lower than they are today. Search trends for Tesla cars are higher now than they were in the last 6 months of 2022. I find that very interesting. What about Tesla Solar? Tesla Solar, you had a drop off here towards the end of the year. That's surprising. That's usually around tax credit time. A nice surge here at the beginning of the year, but definitely lower on Tesla Solar. So Tesla cars up. What about full self-driving? Tesla FSD. This has just been a slow trend up. This makes sense. And what if we do Tesla for somebody who isn't so familiar with Tesla, full self-driving, even though that's what FSD stands for? Yeah, similar kind of trend over here. That's interesting. Okay, so what about Ford? Ford Mach. Is there an E in it? Just here. Ford Mustang Mach-E. Let's see. Let's go to the past year since we've got a weird spike at the announcement there. So over the last year, you've actually been declining on search trends for the Ford Mach-E. What if I just type Mach-E like this? Same thing. Okay, what if I go last 2 years? Yeah, it's straight down for the Maki. Wait, did I do 2 years? No, I still did 1 year. Hold on. There we go. Oh, okay, interesting. So yeah, we're lower than levels where we were in 21, and certainly lower than where we were in 2022. We're kind of at the pit of 2022 for the Mach-E, so that's not that great. What's another popular electric vehicle? Let's see here. Let's see. Yeah, Joel, we could talk about that in the course member live, but yes, they normally do. Ford Mach-E, how about let's see, top EVs United States, and let's just look at the search trends. Let's try Rivian. Rivian. Yeah, okay. Let's go last year. 12 months. Yeah, Rivian trending down. Nissan Leaf trending down. Lucid. Pretty stable here on Lucid. Let's go to 5 years. Yeah, somewhat trending down too. Yeah, Peloton. That would be interesting. Just for giggles, even though that doesn't have to do with cars. Oh gosh. BMW iX. Oh, that's pretty decent. That's iX. What about just I? Nice. I3. I3 kind of trending down slightly there. All right, let's try Ford Bronco for the last year. Pretty stable. So again, this compares to the Teslas, which are at a higher level than where they were in the last 6 months. And it looks like a similar level, a little lower than the beginning of 2022. Fascinating. Let's go Model Y on the 1 year chart. Model Y on the 1 year chart, still higher than where we were, with a nice surge there at the beginning of the year. Ionic, Ionic declining trends in the last 12. If we go to 5 year, it looks like it had some virality over here. It's somewhat been declining. ID3, past year. That's at least got some kind of an uptrend over here. It's pretty good. Anyway, so yeah, gives us a little bit of extra insight. I'm gonna head on over to the course member live stream now. Let's do some analysis together. So we'll see you there. Thanks so much. Bye.